Like everyone else, you may have some financial goals, such as buying a home or saving for your retirement. One way to achieve those goals is to invest some of your saving in the stock market by buying stocks or bonds. What are stocks? This is what we're going to find out in this video. Before we start, please hit the subscribe button to help this channel grow so that we can reach more people, and it helps also with the YouTube algorithm. Please, let's roll the intro. The sole purpose of this video is to help you understand the difference between a stock and a bond. But first of all, I would like to say that I'm not a financial advisor and this content should not be considered as financial advice. And now that we have the legal part out of the way, let's start. Investors are always told to diversify their portfolio between stocks and bonds. But what are the differences between those two types of investments? In this video, we will look at the difference between a stock and a bond on the more fundamental level. What is a stock? When you buy a stock, you buy a small piece of the company, which makes you a part owner of the business. A stock is an investment vehicle. The primary reason why investors own stocks is to earn a return on their investment. Companies sell shares of their business to raise capital for different reasons. Company may decide to use the raised capital to expand the line of business, to put out a new product line, or to pay back some debt. Once a company stock is on the market, it can be sold and bought between investors. These trades are handled through the stock market. Those days, many investors use online platforms to buy and sell shares. The broker trading platform connects sellers and buyers to the exchange. As an investor, we have to learn to diversify our portfolio, and you can do that by buying shares and bonds. Stocks and bonds represent two different ways to raise capital through the capital market. When a company issues stock, they are selling a part of their business in exchange for cash. For a company, issuing stocks is a way to raise capital, and for an investor, investing or buying stock is a way to invest in the company and hoping to have return on your investments. Buying stock is a way to build wealth. Let's say that the company is very successful and they want to expand the business. In this case, they have three choices. You can loan from the bank or raise capital to the capital market. Taking a loan from the bank is very expensive and the interest rate can be very high depending on the amount that you're loaning and the period of time that you taking the loan for. But raising capital on the capital market is way cheaper. The business owner may decide to split the company and sell shares of the business to raise capital. They will be selling portions of those shares on the open market in the process known as an IPO, initial public offering. Once a company stock is on the market, it can be bought and sold among investors. Many investors these days use online stockbrokers to invest in the stock market. The broker trading platform connects buyers and sellers to the exchange market. As a part owner of the business, you make money when the company is making profit and you lose money when the company is not doing so well. When the company is performing well, the stock price will go up. When the company is performing poorly, the stock price will go down or the company can go bankrupt. You have two types of stocks, common stock and preferred stock. What is the difference, you may ask? That's what we're going to see. Common stock and preferred stock both represent some degrees of ownership in the company. Holding shares of common stocks give you the opportunity to vote on the election of the board of directors. It is usually an equivalent of one share vote per share that you own. When you own a preferred stock, it's actually guaranteed the payment of dividend but does not come with the voting rights. Typically, common stock shareholders receive one vote per share to elect the company board of directors. Common stock shareholders also receive voting rights regarding other company matters such as stock split and company objective. One way the profit of the company is distributed to the shareholders is through dividend. Dividends are mostly paid in cash from the company's earnings. Most companies pay their dividend on a quarterly basis. Common stakeholders never know the value of the dividend in advance, while preferred stakeholders receive dividend at a fixed rate. While the dividend on preferred stocks tend to be higher than those on the common stock, they will never appreciate with the company's growth. What is a bond? Often considered to be one of the most conservative of all investments, bonds provide a benefit for both conservative and more aggressive investors. In the financial world, there are fundamentally two types of security investment: debt and equity. Issuing debt bond is an important way for the issuer to raise capital. A bond is like a long-term debt in which the issuing corporation promises to pay the principal amount at a specific date. Generally speaking, the bond contract requires that a fixed interest payment to be made every 6 months. One key way in which the bonds differ from stock is related to the issuer obligation to repay the investor. When an investor buys a stock in a corporation, that investor becomes a part owner. The stock offers the possibility of capital appreciation and dividend payment to the stockholder, with no guarantee that either of those will occur. However, there's no guarantee in the capital appreciation or in dividend. A bond, on the other hand, makes a promise of return to the bondholder. The bond issuer will agree to pay the bondholder a fixed interest payment on a regular basis until the bond maturity, at which point the issuer will pay the original face value of the bond to the bondholder. This indicates the life of a bond. Most bonds have a maturity timeline ranging from 3 months to 30 years. Second, the par value, also called face value, is the amount of the bondholder will be repaid when the bond reaches maturity. Third, the coupon rate, also referred as the interest rate. It is the percentage of the par value that will be paid to the bondholder on a regular basis. Why should investors invest in bonds? You may decide to invest in bonds to take advantage of the many benefits compared to other alternatives. What are the benefits of investing in bonds? First, safety and capital preservation, because the bond issuer must repay back the bond's face value of the maturity. And second, fixed returns. Investors receive fixed rates on a regular basis, which is easy for them to predict versus common stock where the returns are less certain. And third, current income. For those wanting a regular cash income, bonds provide a regular interest payment at a set time. What are the risks involved in investing in bonds? First, credit risk. It is the risk associated with the issuer's ability to make timely payment to its creditors. Second, interest rate. It is the risk associated with the market. Rising interest rates will cause your bond price to fall and decrease the value of the investment. So, which one is better? Should you invest in stocks or bonds? There's no perfect answer to that question. That depends on your strategic and on your risk tolerance. That's it, guys. Thank you very much for watching this video. I hope that you liked it and that it was useful to you. If you have any questions, please put them on the comment below and I'll get back to you. Don't forget to hit the like button and please subscribe to this channel, and I'll see you on the next one. Ciao.